On Wednesday, the Jerome Powell Federal Reserve decided not to hike rates. In my opinion, they decided not to hike rates at least maybe until June, because the US dollar index has started to rally strongly, and also because inflation is starting to pick up. Now, the Federal Reserve did not really admit this too much or sound too worried about it, especially in their Fed statements, as you can see on the screen here from this New York Times article. I'll attach a link to the full New York Times article, but basically in the Fed statement about the non-rate hike that the market expected on Wednesday, they did admit that inflation is picking up, that is closer to their 2% target, but they didn't seem too worried. But there is a lot of evidence that inflation is indeed starting to scare them. So I don't think they want to admit that publicly. I've been saying this for a long time, that stagflation is getting worse. But let's talk about that and also the US dollar index for the rest of this short video. Okay, this is a tweet from a well-respected trader that I follow on Twitter. And he says that core PCE inflation is at 7-year highs. Wage costs are increasing. Input prices paid increasing. Mergers and acquisitions activity higher than in 2007. Record corporate earnings. Share buybacks, cough, cough, with artificially cheap debt. We know the financial engineering game that these large corporate executives are playing. And yet, the Fed is scared to raise rates. And I think one of the main reasons the Fed did not raise rates is they are watching the dollar index. And so the Fed may not manipulate or intervene in the dollar index every single day, but they do watch it. And so there's different plunge protection teams. There's the Exchange Stabilization Fund. The U.S. Treasury itself monitors the dollar index, because we've seen even recently President Trump and also his Treasury Secretary Steve Mnuchin talk the dollar down, say that the dollar was getting too strong, if they want a weak dollar, and then reversing course. Temporary flip-flops here or there, although I think in the long term they do want a weaker dollar. And in the past we've seen evidence of politicians and central bankers and also people in the Treasury Department also talking the dollar up or down. And so this was some technical analysis that I did a couple days ago. The dollar index today, when I'm recording this on Friday, May 4th, 2018, is 92.6. So it's a little bit lower, but this chart is the dollar index year to date. So it's since January. And so you can see here, as I've outlined on the dollar index chart, that basically it's formed a bullish inverse head and shoulders pattern. So this is a textbook bullish inverse head and shoulders pattern that, remember, I did a short video about a month ago talking about the dollar index was testing support levels at between 88 and 89, and that if it had broken those support levels, then the dollar index could have crashed down to 79, and we hadn't seen 79 on the dollar index for years. And the last time we had seen that, I think, was 2013, and the gold price was a lot higher. I believe the gold price was at least $1,500 back then. So the gold price would have had a big move. So in my opinion, there was intervention in an effort to try to prevent the dollar index from going too low too quickly below that 88 support level. And we can see here on this short-term chart of the dollar index that the dollar index has broken out, basically, or at least has had a strong rally. So the question is then, how long and how strong will this dollar index rally be? This is a long-term chart of the dollar index since before 1970. And so if you look at the rally on the dollar index there all the way at the end, this is just a tiny blip. So the dollar index could maybe have a little bit more of a rally, but the dollar index long-term, really since a little after 1980, is clearly in a long-term downtrend. Now, obviously, it's had some strong rallies that have gone on for a while, but if you drew a trend line from that top there to other tops, it would be a clear downtrend. So it does have strong rallies occasionally, and they can last a while, but the dollar itself against the euro, the Japanese yen, the British pound, which is what the dollar index is made out of, is in a clear long-term downtrend. If you look at the support and resistance levels on this chart, there's not a lot of very strong support and resistance levels up until like 100 or 102, 103. So the dollar index could rally strongly over the next couple months, potentially, through 96, 97, maybe test those overhead resistance levels. And if it breaks through there, I would watch, and this is the next technical analysis I did, that this is a trading range. So this is the major support and resistance levels there of around 88's the low. If it breaks 88, it could go to 79 pretty quickly. So I think, the plunge protection team, the Exchange Stabilization Fund, the U.S. Treasury, and others, the Federal Reserve and others, do not want the dollar to go too low too quickly. Now, obviously, they can't fully control the movements of currencies in the long term, but in the short term, they can manipulate currency exchange rates. And anyway, in the long term, they can't manipulate the currency higher. All these governments all want a weaker currency. It's all based off mercantilism, which is to boost exports, they want a weak currency, especially when we don't have gold to balance trade. We don't have gold changing hands with countries that run trade deficits, which used to balance out international trade. So what I would bring up, and you could see that I typed this out on my screen, is that barring something unforeseen, especially if there's a rate hike maybe in June, which would potentially strengthen the dollar even further, that if the dollar were to continue to rally, as we saw on the short-term technical analysis, it could potentially go to 100 to 102. But if the dollar were to go above those overhead resistance levels and say really break out to above 102, 103 and continue getting stronger, that would signal to me at least that the next global financial crisis was imminent, that there was a problem in credit markets, either problem with European banks or problem with banks lending to each other or problem with emerging markets that had borrowed way too much money in US dollar denominated debt, etc., etc. Now, the dollar rally could potentially sputter out. We could see the dollar sputter out as well over the next couple months and go back to test those 88 support levels. But I think, at least for a while, the dollar index for the next couple months, it may be range bound. But I would watch on the support levels, the dollar breaking below 88. And on the overhead resistance, if the dollar index, I don't think there's really a lot of overhead resistance for the dollar index to test 96, 97. But if it breaks through those levels, it could test 100 to 102 pretty quickly. And like I said, that would start to signal to me that maybe there's another crisis because, remember, over for a year now, the Federal Reserve had been hiking rates. And despite those rate hikes from the Janet Yellen Fed, they had not strengthened the dollar. The dollar index went from 102-ish a little over a year ago down to 88, despite rate hikes. So I think long term, the reason the dollar was getting weak is that people, market participants, whether that's foreigners or other market participants, are truly worried about these budget deficits, trade wars, long-term unfunded liabilities that the U.S. government has. Coming up in October, quantitative tightening, which I think is a really stupid name, just say Federal Reserve balance sheet reduction, is supposed to ramp up to $50 billion per month. So on an annualized basis, I don't know if the Federal Reserve will be able to unload $600 billion worth of assets, but the Fed wants to, at least right now, claims that it wants to continue to hike rates in the near future and also to drastically reduce its balance sheet by $600 billion. And in addition to that, the budget deficits that President Trump and Congress are running with these tax cuts and other expenditures are looking at least $1.2 trillion budget deficits for the foreseeable future. So, those things, historically speaking at least, are not good for the strength of a currency, although raising rates normally is pretty good for a currency, but when you're trying to balance that raising rates on one hand versus enormous budget deficits on the other, plus huge unfunded liabilities, then I think that's why a lot of people are very dollar bearish now. But it was an overcrowded trade, and there could be a short squeeze because there was a lot of professional managed money, hedge funds and such, that were getting very short dollar, that it had become an overcrowded trade, at least temporarily. So comment below what you think about my technical analysis of the dollar index. Like I said, if the dollar index breaks above overhead resistance levels of above 102 or 103, I think that would signal that there's another global financial crisis potentially imminent. And the last chart I wanted to talk about is this. So this is a 43-year historical chart of the dollar index. Now you'll notice that the numbers are different and the methodology is explained. I copied and pasted this from the website with this on the slide here. And this is a inflation adjusted dollar index, but it's also, look, as you can clearly see, in a long-term downtrend. And you could see here where I'm moving my mouse that this is the rally that we've had in the dollar. So it's really not that significant yet, the rally in the dollar, but it could. We'll have to see how long this rally continues. Comment below this video if you think the dollar rally is going to continue for a while, or if you think that this is just a dead cat bounce. But it looks like, based on the short-term technical analysis I did, that the dollar rally will continue at least for a little while longer, and we'll have to see how long the dollar index rally is going to continue. Okay, well, that's it for today's short video, guys. Bye. Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street from Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone, despite YouTube censorship, and hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street from Main Street email list that's on the wallstreetfrommainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetfrommainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.